David bought his first Bitcoin in 2021 at $42,000. He wasn't some crypto fanatic or get-rich-quick chaser. He's a software engineer, 34 years old, who'd been reading about Bitcoin for years and finally decided it made sense as a small part of his portfolio, maybe 5% of his investments. Diversification, hedge against inflation, all the stuff the financial media had been talking about. He watched it climb to $69,000 in November 2021. He didn't sell. He wasn't trying to time the market. Then he watched it crash to $16,000 in 2022. He didn't panic sell either. He held through the volatility because he understood the long-term thesis. But something started bothering him around late 2023 and into 2024. The price movements stopped making sense. Bitcoin would surge 15% in a day on no news, then crash 12% the next day, also on no news. Massive buy orders would appear out of nowhere, pushing the price up, only to be followed by equally massive sell orders hours later. The patterns looked orchestrated, manipulated. And David started asking a question that a lot of people are quietly asking. If Bitcoin was supposed to be this decentralized, unmanipulable alternative to traditional finance, why does it feel like someone's pulling the strings? The answer is uncomfortable. Banks found a way in, and they brought their old tricks with them. My name is Fad, and I spend way too much time thinking about how traditional financial institutions are reshaping cryptocurrency markets in ways most people don't see. If you're someone who invested in Bitcoin expecting it to operate outside the traditional financial system, only to watch price action that feels increasingly controlled and manipulated, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Here's the core issue that nobody wants to say out loud. Bitcoin and cryptocurrency markets in general were supposed to be different, decentralized, transparent, immune to the kind of price manipulation that's plagued traditional financial markets for decades. No central authority, no banks controlling the flow, just code, math, and a distributed network. But over the past few years, something fundamental changed. Large financial institutions, the very entities Bitcoin was designed to circumvent, figured out how to insert themselves into the ecosystem. And they didn't just participate, they brought the entire playbook of traditional market manipulation with them. Futures contracts, ETFs, derivatives, leveraged trading, and a strategy that's been illegal in stock markets since 2008 but remains perfectly legal in crypto: spoofing. David isn't wrong to feel like the game changed. It did. What he's seeing isn't organic market volatility driven by supply and demand. It's coordinated price manipulation, facilitated by regulatory gaps that allow institutions to do things in crypto markets that would land them in federal prison if they tried it with stocks or commodities. The problem is this. Bitcoin's price is increasingly determined not by people buying and holding actual Bitcoin, but by institutions trading Bitcoin derivatives, futures contracts, and ETF shares that don't require them to own the underlying asset at all. They're trading the idea of Bitcoin, not Bitcoin itself. And in doing so, they've created a shadow market that's 10 times larger than the actual Bitcoin market, giving them enormous leverage to move prices in whatever direction benefits their positions. This isn't a conspiracy theory. This is documented, observable, and happening in broad daylight. And if you own Bitcoin or you're thinking about buying it, you need to understand exactly how this mechanism works.
Let's go back and understand how we got here. Bitcoin launched in 2009 with a very specific vision, a peer-to-peer electronic cash system that didn't require trusted third parties. For the first several years, it operated mostly as intended. People bought Bitcoin, held it in wallets they controlled, and the price was determined by actual supply and demand on exchanges where real Bitcoin changed hands. But as Bitcoin grew and the market cap reached hundreds of billions of dollars, Wall Street took notice. And Wall Street doesn't like markets it can't control. So starting around 2017, major financial institutions began building infrastructure to bring Bitcoin into the traditional financial system. The CME, the Chicago Mercantile Exchange, launched Bitcoin futures in December 2017. The price of Bitcoin peaked that same month at nearly $20,000, then crashed 83% over the next year. Coincidence? Maybe. Or maybe the introduction of futures contracts allowed institutional traders to short Bitcoin with leverage they'd never had access to before. Futures contracts are agreements to buy or sell an asset at a predetermined price on a future date. Critically, you don't need to own the underlying asset to trade futures. You can sell a Bitcoin future, a promise to deliver Bitcoin at a certain price, without owning any Bitcoin at all. This is called a naked short, and it's a powerful tool for price suppression. But futures were just the beginning. In 2024, the SEC approved spot Bitcoin ETFs, exchange-traded funds that theoretically hold actual Bitcoin and allow investors to gain exposure through traditional brokerage accounts. On the surface, this seemed like a legitimization of Bitcoin, a sign of mainstream acceptance, and it is in a sense, but it also created a new vector for manipulation. Here's why. When you buy shares of a Bitcoin ETF, you don't own Bitcoin. You own shares of a fund that claims to hold Bitcoin. The ETF is required to buy Bitcoin to back those shares, but there's a lag. There's flexibility in how they manage that backing, and most importantly, the ETF itself can be shorted. Institutions can borrow ETF shares and sell them, driving the price of the ETF down, which in turn affects sentiment around Bitcoin's price, which affects the actual Bitcoin price on exchanges. And then there's the derivatives market. According to data from CoinGecko and various analytics firms, the derivatives market for Bitcoin, futures, options, perpetual swaps, is approximately 10 times the size of the spot market where actual Bitcoin trades. 10 times. That means for every real Bitcoin being bought or sold, there are 10 synthetic Bitcoins being traded in the form of contracts. And those synthetic Bitcoins have enormous influence over the price of real Bitcoin. This is the loophole. Bitcoin's price is no longer primarily determined by the supply and demand of actual Bitcoin. It's determined by the supply and demand of Bitcoin-related financial products that don't require ownership of Bitcoin. Let's walk through how this actually works in practice, because the mechanism is more straightforward than it sounds. Imagine a large investment bank, let's call them Bank X, wants to suppress the price of Bitcoin. Maybe they have clients who are short Bitcoin. Maybe they're managing risk on other positions. Whatever the reason, they have a motive to push the price down. Here's what they do. On the CME Futures Exchange, Bank X places a massive sell order for Bitcoin futures contracts. Let's say contracts representing 10,000 Bitcoin at $65,000 per Bitcoin. That's a $650 million notional position. Critically, they don't need to own 10,000 Bitcoin to do this. They just need to post margin, which might be 10% to 20% of the notional value. So they're putting up maybe $65 million to $130 million to control a $650 million position. That massive sell order hits the market. Other traders see it. Algorithms see it. It looks like someone with serious capital thinks Bitcoin is going down, so other traders start selling too. The futures price drops. Let's say it drops from $65,000 to $63,000, a 3% move. Now, here's where it gets important. Bitcoin spot exchanges, the places where actual Bitcoin trades like Coinbase, Binance, Kraken, they watch the futures market closely. Many of them use futures prices as reference points. When futures drop 3%, spot prices tend to follow. Arbitrage traders make sure of that. If Bitcoin is $65,000 on Coinbase, but futures are trading at $63,000, arbitrageurs will short Bitcoin on Coinbase and buy the cheaper futures, profiting from the difference and, in the process, bringing the spot price down to match futures. So Bank X's futures sell order, which didn't involve any actual Bitcoin, just caused the real Bitcoin price to drop 3%. Now, multiply this across multiple institutions, multiple exchanges, 24/7 trading, and you see how price can be systematically managed. But it gets more sophisticated. There's a tactic called spoofing. You place large buy or sell orders with no intention of executing them, just to create the illusion of demand or supply. Then you cancel the orders before they fill. This is illegal in regulated markets. The Dodd-Frank Act made spoofing a federal crime in commodity markets in 2010. Traders have gone to prison for this in gold, oil, and stock markets. But in cryptocurrency markets, which are largely unregulated, spoofing happens constantly. A 2019 study published by researchers at the University of Texas found that a single entity was responsible for approximately half of the Bitcoin price increase in 2017 through wash trading and spoofing on unregulated exchanges. Half. Let's say Bank X places a fake buy order for 5,000 Bitcoin at $64,000. The order sits on the book. Other traders see it and think there's strong demand at that level, so they buy, pushing the price up to $64,500. Then Bank X cancels the order and sells into that higher price, profiting from the move they artificially created. This happens thousands of times a day. Automated trading algorithms do this at speeds humans can't match. And because there's no meaningful regulation or enforcement in most crypto markets, there's no penalty. David, holding his Bitcoin, sees his portfolio swing 10% in a week based not on actual adoption, not on real-world use cases, not on fundamental changes to the Bitcoin network, but on institutional traders playing games with derivatives and fake orders.
So why does this feel so invisible to most people? Why doesn't this make headline news? First, there's a psychological component. Bitcoin and crypto in general attract a certain type of believer. People who bought into the decentralization narrative, the idea that this is a revolutionary technology immune to traditional financial manipulation. Admitting that banks have successfully infiltrated and manipulated the market feels like admitting the whole premise was wrong. There's cognitive dissonance, so people rationalize the volatility as, that's just crypto, or weak hands getting shaken out. Second, there's the complexity barrier. Most people don't understand futures markets, derivatives, or how ETFs actually work. When you tell someone that Bitcoin's price is being manipulated through futures contracts they don't own, their eyes glaze over. It sounds abstract, theoretical, like something that couldn't possibly have real impact, but it does. Third, and this is critical, the regulatory system is designed to allow this. The Commodity Futures Trading Commission, the CFTC, regulates Bitcoin futures, but they regulate them the way they regulate commodity futures, with rules designed for corn and oil, not digital assets. The SEC regulates Bitcoin ETFs, but with frameworks built for equity funds, not decentralized networks. And spot Bitcoin exchanges? In the US, they're barely regulated at all. There's no equivalent to the SEC's surveillance and enforcement for spot crypto trading. This creates a regulatory arbitrage opportunity. Institutions can do things in crypto markets that are outright illegal in traditional markets simply because no one has clear jurisdiction or authority to stop them. And there's a structural incentive alignment problem. The institutions now deeply embedded in Bitcoin trading make money from volatility. They don't profit from Bitcoin going up steadily. They profit from Bitcoin swinging wildly, because that's when their trading desks make money. That's when their derivatives products get used. That's when fees and spreads widen. Stability is bad for their business model. So there's a systemic incentive to keep Bitcoin volatile, to manipulate it in ways that create trading opportunities.
The original Bitcoin holders, the people who bought in because they believed in decentralization and sound money, they're now sharing the market with institutions whose entire profit model depends on price manipulation. And those institutions have vastly more capital, better technology, and no regulatory constraints. David feels like someone's pulling the strings because someone is. Multiple someones. And the system not only allows it, the system is designed to facilitate it. Here's the reframe, and it's difficult but necessary. Bitcoin is no longer the asset it was marketed as, at least not in terms of how its price is determined. The Bitcoin network itself, the blockchain, the decentralized ledger, that still works exactly as designed. No one can manipulate the supply. No one can counterfeit Bitcoin. No one can censor transactions. That part is intact. But the price discovery mechanism, the process by which Bitcoin's value is determined in dollar terms, that's been captured by traditional finance. And if you're investing in Bitcoin, you need to separate those two things in your mind. You can believe in Bitcoin's long-term value proposition as a decentralized store of value or medium of exchange, while simultaneously recognizing that its short-term and medium-term price movements are heavily influenced by institutional manipulation. This doesn't mean Bitcoin is worthless or a scam. It means that if you're buying Bitcoin as an investment, you're not escaping the traditional financial system. You're participating in a market where traditional financial institutions have enormous power to move prices in directions that benefit them, often at the expense of retail holders. The goal here isn't to scare you away from Bitcoin. The goal is to help you understand what you're actually buying and what you're actually exposed to when you invest in cryptocurrency in 2025. If you believe Bitcoin's long-term thesis that it will eventually reach mass adoption as a store of value or that its fixed supply makes it valuable in an inflationary world, then short-term price manipulation by banks shouldn't change that belief. But it should change your expectations about volatility and your strategy for buying and holding. You're not investing in a purely decentralized asset immune to manipulation. You're investing in an asset whose price is subject to all the games and gamesmanship of traditional markets, with less regulation and more room for abuse.
So what do you actually do with this information? How do you invest in Bitcoin or think about Bitcoin in a way that accounts for this reality? Step 1. Adjust your volatility expectations. If you're buying Bitcoin, understand that 20%, 30%, even 50% price swings are not anomalies. They're features of a market where institutional traders can use massive leverage and unregulated tactics to move prices. Don't invest money you'll need in the next few years. Don't invest money that you'll panic sell if it drops 40%. This isn't safe, stable, predictable price action. It's a battlefield. Step 2. Avoid leverage yourself. One of the ways institutions profit from retail investors is by liquidating leveraged positions. If you're buying Bitcoin on margin or using leverage, you're giving institutions a target. When they push the price down suddenly, they're hunting for liquidations, forced sales that add to the downward pressure and let them buy at lower prices. Don't participate in that. If you buy Bitcoin, buy it outright with cash you can afford to lose. Step 3. Cost average, but intelligently. Dollar cost averaging, buying a fixed amount at regular intervals, smooths out volatility, but be aware that institutions manipulate price at predictable times. End of month, end of quarter, options, expiry dates. These are times when price manipulation intensifies because that's when derivatives contracts settle. If you're going to cost average, consider doing it at random times rather than on a set schedule that aligns with market structure events. Step 4. Custody your Bitcoin. This is controversial, but if you believe in Bitcoin's long-term value and you're not actively trading, get it off exchanges and into a wallet you control. When Bitcoin sits on an exchange, the exchange can use it for their own purposes, lending it out to short sellers, using it as collateral. When you control your Bitcoin in a private wallet, it's off the market, not available to institutions for manipulation purposes. This doesn't protect you from price volatility, but it does mean you actually own the asset rather than an IOU.
Step 5. Separate signal from noise. Don't try to trade based on short-term price movements. You will lose. Institutions have better information, faster execution, and more capital. If you're buying Bitcoin, buy it for long-term reasons and ignore daily, weekly, even monthly price action. The manipulation is concentrated in short-term timeframes. And finally, step 6, recognize this for what it is. You're not investing in a revolution that escaped traditional finance. You're investing in an asset that traditional finance is actively incorporating and manipulating. That doesn't make it a bad investment necessarily, but it does mean you need to go in with eyes open, understanding that the game is not fair, the playing field is not level, and the institutions have significant advantages. Bitcoin might still succeed long-term. It might become a widely adopted store of value. It might reach $100,000, $500,000, higher. But the path there will be manipulated, volatile, and painful for anyone who doesn't understand what they're up against. Let me leave you with this. David still owns his Bitcoin. He's down overall from his entry in 2021, but he hasn't sold. What changed is his understanding. He no longer checks the price every day. He no longer tries to make sense of daily volatility. He accepts that the market is manipulated, that institutions have the power to move prices in ways that have nothing to do with Bitcoin's fundamental value, and that his only rational response is to hold for the long term or not hold at all. The loophole banks found isn't really a loophole. It's a feature of an under-regulated market that allows traditional financial institutions to apply century-old manipulation tactics to a 21st century asset. They use futures to move spot prices without owning Bitcoin. They use spoofing to create false signals of demand or supply. They use their capital advantage and access to leverage to dominate price discovery. This doesn't mean Bitcoin has failed. It means Bitcoin's price, at least in the short and medium term, is not determined by the principles Bitcoin was built on. It's determined by the institutions that figured out how to profit from it. If you're investing in Bitcoin, understand that. Don't expect fair markets. Don't expect price movements that make sense based on adoption or fundamentals. Expect manipulation, expect volatility, and structure your investment strategy accordingly. Long time horizon, no leverage, money you can afford to lose, and the emotional fortitude to ignore price swings that are designed to shake you out. The game is rigged. It's always been rigged in financial markets. Bitcoin didn't escape that. It just gave the riggers a new playground. If you're going to play, play with that knowledge. And if you can't handle that reality, there's no shame in sitting this one out. If this helped you understand what's actually happening in crypto markets behind the hype and the price charts, hit the like button. If you want more honest breakdowns of how financial systems actually work, not how they're supposed to work, subscribe. And drop a comment. Let me know if you've noticed these patterns in your own Bitcoin investing. I read every one. Thanks for watching. I'll see you in the next one.